Sir, your audio is muted.
Sorry. Yeah, namaste to all.
Namaste.
Welcome you all to this another webinar of your own accounting standard board. And today we have two eminent panelists to discuss the issue. The matter, I would say, not issue, basically. We've got C.A. Venkat Pillaiji, who is, of course, a member of our institute, a member of the Institute of England and Wales, also the CMI of UK. He is also the CFE or the CFO of the plan.net, and he has got a tremendous experience in the commercial as well as Ind AS and the accounting standards. To be very frank, he is currently from the industry. Am I right, Venkatji?
Sorry, sir.
You're from industry right now.
Yeah, that's correct, sir. I am from the industry.
So we would be having the industry perspective on this foreign exchange fluctuation. I welcome you, Venkat sir, to this webinar. Welcome.
Thank you, sir.
Another eminent panelist which we have is CA Maitri Swaminathan. She's of course a rank holder both in CA and CS, and has got more than 2 decades of experience in now more specializing more into the sustainability world, the ESG, and she's been the finance director and CFO for the India operations and regional finance controller in the leading Fortune 500 companies. Of course, she has been contributing a lot to the board through her various disseminations. I welcome CA Maitri Swaminathan ji to this esteemed panel. And to moderate these two star panelists, we have got another star moderator, I would say, who is the past chairman of the Bengaluru branch of our ICI, CA Shravan Gurthar. He is practicing, and the most important point that today we had a moderator who was a different person, but at the end moment she had certain medical issues in the family. So thanks a lot, Shravanji, for agreeing to moderate this session in a very, very short notice. Friend, today this session is on a very, very important subject of foreign exchange transactions and translations. Friend, if I talk about this foreign exchange now, most of our, I would say, those who are into industry or in practice, most of the entities, many of the entities are having the foreign currency transactions. How that is to be accounted for? What at the time of transaction? What at the time of payment? What would be the mark to market at the year end on various transactions, including, I would say, purchases, sales, services, then my loans, interest, or so many other transactions which are having on the equity and the other model. So a good discussion. We are hoping that everyone who is listening to this webinar today, right now, and even later on, because this webinar would be available later on also on the ICI TV. The link is there on the ICI TV as well as our ASB portal. It would be there. So I'm hoping that everyone gets enriched through the very good discussion among the panelists to be moderated by C.A. Shravan. So I'm here handing over the whole session to C.A. Shravan for the further dissemination. Thank you.
Thank you, Pramod Jain, sir. It's always a pleasure to be a part of the Accounting Standards Board, ICI. Friends, as all of us are aware, businesses of the current day and age are increasingly involved in foreign exchange related transactions. It could be in the form of foreign currency transactions, or it could be in the form of foreign operations. Like Pramod Jain sir mentioned, this session is all about picking the brains of the two eminent panelists. We have with us Ms. Maitri Swaminathan, as well as Mr. Venkat Pillai, both experts in their specific domains, who will be taking us through the specific aspects of Ind AS 21 vis-a-vis AS 11. So without further ado, let me first start with my first question to Venkat sir. We will start with the basics, friends. Venkat sir, could you please help us by discussing a couple of important definitions that form part of the Ind AS 21, which actually capture the essence of the Ind AS?
First of all, thank you, Pramodji, Shravanji, and Maitriji for participating in this session. And thank you for your question as well. So let me just start with the objective of this standard, which talks about two types of foreign activities. One having transactions with foreign currencies and also foreign operations. Now, how to include the foreign currency transactions and foreign operations in the financial statements? That's my point number one. Then how to translate the financial statements into a presentation currency. So we'll come to the definitions. What is the presentation currency? What is the functional currency? Determine the exchange rate to use and look at and report the effects of the foreign exchange in the financial statements. That's what this the standard talks about, is essentially. Now, coming to the definition, specific thing on the definitions part. So the standard talks about functional currency. Earlier, we used to have AS, the erstwhile Indian GAAP, where it was never classified, any currency was classified as functional currency. So it's a very novel thing which was brought in.
Sir, it is not erstwhile Indian GAAP, sir. AS abhi
hai, sir. Thank you for pointing.
Sorry to disturb, but you know, out of 50 lakh audit for financial statements, only 47,000.
Right. So it's, I mean, we are accustomed to looking at it as a new standard, and definitely, sir, I agree that AS is also relevant relevance so far. And functional currency is the currency of the primary economic environment in which the entity operates. So it talks about primary economic environment in which the entity operates, and the currency which is used there is the functional currency. So anything other than the functional currency becomes a foreign currency. So here you are concerned with only two currencies. The one is the functional currency and the foreign currency. But then you'll come to a presentation currency also, because you need to present your financials in a currency. So that can be different. The standard talks about the different presentation currency also being a currency which is different from these currencies. So what is the exchange ratio? Exchange ratio is the ratio of exchange of these two currencies. One is the foreign currency and the other is a functional currency. So anything and everything which is foreign, I need to convert into functional currency. Then it gives you a definition of foreign operation. So foreign operation is an entity that is a subsidiary, associate, joint arrangement or branch, the activities of which are conducted in a country or a currency other than the reporting entity. So the reporting entity and the foreign entity is different. So any operations happening outside will be considered as a foreign operation. Then also talks about monetary items. So I've just touched upon the important definitions which I thought is relevant to understand this particular standard. The monetary items are units of currency held and assets and liabilities to be received or paid in a fixed or determinable number of units of currency. So anything which is a unit of currency held or an asset and liability to be received or paid in a fixed or determinable number of units of currency is a monetary item. So monetary item is different as distinct between a financial and a non-financial asset. Here it doesn't talk about financial or a non-financial asset. It talks about monetary and non-monetary items. So that is the key to understanding the standard. So as per MCA, the financial performance and financial position needs to be prepared in Indian rupees. So we have an answer for as far as the India is concerned. But then you need to look at the various definitions. So quickly I touch upon what are the indicators for determining functional currency. So any currency which mainly, there are conditions given, condition A and condition B. Condition B where it mainly influences sales price of goods and services. Any currency which influences sales price of goods and services, and the current currency of the country where competitive forces and regulations determine the sales price of goods and services. So any currency which determines your sales price, any currency of the country where competitive forces and regulations determine the sales price of goods and services. Is one condition. The condition B, anything which mainly influences apart from the sales, the corollary of the sales is material, labor, material, and other costs of providing goods and services. So any currency which influences that also should be considered. So this is the key to understanding the standard, the primary indicators for determining a functional currency, because functional currency, I need to dwell upon it because functional currency is what is being used everywhere in the standard. Then the talks about secondary indicators. Now, if the primary indicators are very clear to you, go ahead and do classification as a functional currency. Nobody is going to ask, no auditor is going to question you. If we're able to satisfy both the primary indicators. But if it is not, then the standard says you need to go further and look at your secondary indicators. The currency in which the funds from financing activities, including debt and equity instruments, are generated. So when you're funding, when you're getting funded and you're getting the money in a particular currency, that currency can also be considered for determining your functional currency. Currency in which the operates, then it goes to the operating. One is financing, then the other goes to operating. When you get your receipt from operating activities, and usually you're retaining those receipts in a particular currency, go ahead and use that as your barometer to consider your classifying a currency as a functional currency. Now it says I'll briefly touch upon in the interest of time. There are 4 additional factors which they talk about, which it talks about an extension of a foreign operation being an extension of entity with a significant degree of autonomy. Here we are talking about significant degree of autonomy, whereas the earlier accounting standard or the prevalent Indian accounting gap talks about integral and non-integral operation. So that is a difference. Here it talks about significant degree of autonomy. If a foreign operation is considered, those currencies can be looked at for the purpose of functional currency. And whether transactions with the reporting currency are a high or low proportion, then also you can look at the currency from that angle. Then it says whether cash flow from the activities of foreign operations are directly affect the cash flow of the reporting entity, then also you can consider that. The last one is whether the cash flow from activities of foreign operations are sufficient to service the existing debt. If you're taking a debt, the foreign operation has taken a debt, and their cash which is generating is sufficient to satisfy the debt obligation, then also that currency being considered for classification as a functional currency. Shravan?
Well put together, Venkat sir. Maitreyi madam, could you please take us through, when we talk about the applicability of these standards, could you please take us through if there are any specific exclusions from Ind AS 21, please?
Thank you, Shravan, and good afternoon, everyone. Thank you, Venkatji, for taking us through those definitions. And, like Shravan said and Pramodji said, this standard basically aims at telling us how to translate, how to account for foreign exchange transactions, whether it's when they initially occur or later in terms of translation, or when we have foreign operations, when the presentation currency is different, all of that. So it broadly covers all the foreign exchange transactions that may be performed by an entity. But there are certain exceptions. So wherever there is a specific accounting standard that deals with the subject, that in broad terms, I would say, have been carved out as exceptions to the standard, one of which is, say, cash flows. This accounting standard does not apply to presentation of cash flows where the transactions arise in foreign currency, or for translation of cash flows of a foreign operation, because Ind AS 7, which is the statement of cash flows, deals with how to translate foreign exchange items in a cash flow. So that is one of the exceptions. The other exception is, let's move to financial instruments, Ind AS 109. So that applies to a number of foreign currency derivative items and so on. And so since they are dealt with specifically by a separate accounting standard, this particular accounting standard, Ind AS 21, does not deal with hedge instruments or financial instruments. Of course, there is an exception to this exception. So if there are foreign currency derivatives that are not within the scope of Ind AS 109, and one of the examples is an embedded currency derivative within a contract, then that would fall within Ind AS 21. So again, dealing with hedge, the standard does not, Ind AS 21 does not apply to hedge accounting, because Ind AS 109 applies to hedge accounting. Of course, again, as an exception to that, when an entity translates amounts relating to derivatives from functional currency to its presentation currency, that is where a presentation currency of an entity is different from its functional currency, and there is translation of amounts relating to derivatives, then Ind AS 21 will apply to it. So there are exceptions to exceptions. I hope that's not been too confusing for everyone. But that's where we stand, where there's a specific standard that deals with the item. Then Ind AS 21 will not deal with it, specifically, cash flows and financial instruments.
Thank you, Madam. Like Pramod sir was previously mentioning, Venkat sir, we have more than 95% of the companies in India still falling under the IGAP requirements. So can we take this opportunity to understand how different Ind AS 21 is from AS 11, please?
Yeah. There is a subtle difference between Ind AS and AS, like I mentioned earlier as well. There is no concept of functional currency in Ind AS 11. There are only operations which are talked about. The foreign operations are translated basis whether they are integral or non-integral to the reporting entity. Whereas in Ind AS 21, you have functional currency, which is the currency of the primary economic environment in which the entity operates. There is also a presentation currency in as far as Ind AS 21 is concerned, whereas there is no presentation currency in AS 11. The very key, one of the key differences is exchange difference on monetary items forming part of the net investment in a foreign operation. We'll come to that in the next few session later on the session, where if that the foreign exchange differences arises, what happens in Ind AS 21 is that in a separate financial statements in the SFS, it's recognized in the profit or loss in the period in which they arise. So then what happens to the CFS, the consolidated financial statements? It's recognized in the OCI, the other comprehensive income, and reclassified to the profit or loss as and when the foreign operation is disposed of. So this is a very key difference between the Ind AS. So what does the AS 11 talk about? AS 11 talks about combining both separate financial statements as well as consolidated financial statements. It is moved, the exchange differences are moved to foreign currency translation reserve until the disposal of net investments when the income or expenses recognized in the profit or loss. This is the difference. So in the AS 11, SFS and CFS both have it in the foreign currency translation. There's no concept of OCI in AS. So it goes into a foreign currency translation reserve. And from there, it goes into the P&L as and when the net investment in the foreign operation is liquidated, disposed of. So again, in Appendix B of Ind AS 21, gives you guidance on advance considerations. When advance money is received, how do you treat that? That is missing in AS 11. And forward exchange contracts and other similar financial instruments is excluded in AS 21. Whereas in AS 11 gives you the foreign exchange contracts, except those entered into hedge, foreign currency risks of future transactions, where firm commitments are made. So only for those you can use AS 11, whereas Ind AS 21 very clearly excludes forward exchange contracts. Shravan.
Thank you, Venkat sir. Maitreyi madam, keeping in the hindsight the various differences that Venkat sir just touched upon between both the standards, do you see any specific challenges? Let's assume I'm a company going for a first-time transition to Ind AS today. What are the specific challenges that I as the company would face while doing this transitioning? Can you throw some light, madam?
Thanks, Shravan. Venkatji, very clearly laid out all the differences between Ind AS 21 and AS 11. Now, each of these needs to be a point of consideration for a company that is going to first time implement Ind AS 21 for their financial statements. Let's go, one by one and look at some practical aspects of it. So first is, and primary is the functional currency approach that is there in Ind AS 21. So at the time that an entity is planning to implement Ind AS 21 accounts, a determination of the functional currency needs to be done. And functional currency, like Venkatji earlier explained, it's part of the primary economic environment in which the entity operates. So there's a whole determination of which is the currency that determines my sale price, which is the primary currency of sale of my goods, which is the primary currency in which I'm incurring expenses. If these which are part of category A are not fulfilled, then go on to category B. And then if none of those conditions are satisfied, then a management determination of what needs to be my functional currency. And functional currency is not a matter of choice, Shravan, where sometimes management may think there's a matter of choice in determining functional currency. It's a very systematic process of determining either revenues, cost-based, loan-based, source of funds, all of that in determining what is my functional currency. And the first time determination of functional currency is perhaps the most important because it's very rare for functional currency really to be changed. And perhaps we can touch upon that as well later on today. So first and foremost is determination of the functional currency. Again, if the entity has foreign operations, then the foreign operations also need to determine their functional currency, which may be very different from the presentation currency. So the fact that functional currency has been introduced in this accounting standard makes the determination of functional currency for each geography of operation extremely critical. That's the first practical challenge. Second is determining my presentation currency. And the Ind AS 21 has this beautiful concept where my presentation currency can be very different from my functional currency if the users of my financial statement would get more value by looking at a currency that's different from my functional currency. So there could be a determination point for management to make whether there is any value to a presentation currency being different from the local currency and perhaps even being different from the functional currency of the environment in which the entity functions. I think apart from this, the third one, which Venkatji touched upon again, is where we have foreign operations. Where there are foreign operations earlier, there was a foreign currency translation reserve or an FCTR in both the foreign operations as well as the parent entity. The parent entity does not have so much of a challenge because FCTR is now replaced by OCI, which is again a balance sheet item. But for the accounting of the foreign operations, the FCTR account that was so far there when we were operating under an AS 11 environment will need to be evaluated and perhaps reclassified into profit and loss account once the Ind AS 21 implementation happens. So this is another practical aspect to be cognizant of when moving towards Ind AS 21 accounts. This apart, there are other small items that may need to be taken care of. For instance, if the exchange differences on a capital item were earlier capitalized. So that is what I'm talking about is long-term monetary items in foreign currency. So if the exchange difference on this, the entity had capitalized them, if these items related to acquisition of depreciable capital assets, then Ind AS 21 allows for the first time implementation to continue to apply the accounting policy opted for long-term foreign currency monetary items as per the previous gap. So if there is any such option to be made, it needs to be made at the time of the first time implementation of Ind AS 21. So these are some of the practical considerations in the first time implementation of Ind AS 21. Over back to you, Shravan.
Interesting, madam. So since we have touched upon in the last few minutes already on the applicability, and you also touched upon the challenges when we talk about first-time implementation, madam, my next question to you is to you only. Can you also throw some light on what are the rules of initial recognition?
Okay. Shravan, initial recognition would come when we incur or when we enter into a transaction in foreign currency. How do you initially recognize that in the books of account? So that's the rules of initial recognition. And how we do it is all transactions, all foreign currency transactions have to be recorded in an entity's functional currency on the initial recognition using the spot rate on the date of transaction. So several aspects of this. One, it has to be recorded in the entity's functional currency, right? Second, what is the rate to be used? The rate to be used is the spot rate. So, and what is the date pertinent to the rate? The date pertinent to the rate is the date of the transaction. So three aspects to this: to be recorded in functional currency, at the spot rate, and the spot rate prevailing on the date of the transaction. Of course, for practical reasons, there is an option where Ind AS 21 says, in case there are a number of sale transactions or number of expense transactions in foreign currency, to track the spot rate of each of the transactions may be challenging. And so Ind AS 21 allows the use of an average rate if it's a reasonable approximation of the actual rate and if the exchange rate does not fluctuate significantly. So that again, tracking whether exchange rates fluctuate significantly, and a management determination of whether the average on a weekly basis, an average on a monthly basis, what is appropriate for the particular industry or for the particular number of transactions an entity is incurring needs to be made, and that's a management determination. But Ind AS does permit the use of an average rate. So as an exemption to using a spot rate on the date of transaction, we can also use an average rate for the chosen period. Back to you, Shravan.
Right. So now that we are clear, friends, on what needs to be done at the time of initial recognition, Venkat sir, could you help our audience with any specific rules in relation to subsequent recognition, please?
Yes, I think my 3G touched upon the initial recognition. Now we have the standards are always classified into the initial recognition and subsequent measurement and recognition. So how is subsequent measurement or recognition done? The classification is again monetary, non-monetary. So thumb rule is monetary, monetary. There is no financial, non-financial. Like I started the discussion, monetary, non-monetary. So it gives you clearly articulated rules. Monetary items are at the closing rate, at the closing exchange rate between the functional currency and the foreign currency. You will translate the monetary items. All non-monetary items, if they are measured at historical cost, then the exchange rate used at the date of the transaction. Simple. Now, the analogy to historical cost is you do a fair valuation. So any non-monetary asset item which is measured at a fair value, using the exchange rate at the date when the asset was or the item was fair valued or the fair value was determined. That is the rate at which you will use for translation as per the standard. And like Maitriji articulated, there is the usage of average rate where there is no abnormal volatility in the forex rates. So long as there is no abnormal volatility, go with the average. But if there is an abnormal volatility, don't go with the average. Use your judgment to arrive at your subsequent recognition. Over to you, Shravan.
Venkat sir, continuing with you, can you also help us with the rules of recognition of exchange differences? How do we go about that?
Once you do an initial recognition, you do a subsequent recognition, or in between there is something called a settlement. So if your monetary item, which includes an asset or liability, is settled, so what do you do when it's settled? So when you settle your monetary item or when you translate your monetary item at rates different from those at which it was initially recognized, or in the previous financial statements, you can have any monetary asset even carrying forward for the previous financial statements. The standard says that the exchange differences to be recognized in the profit and loss account in the period in which they arise. So it's very clear. So because these are monetary items and because there's a fixed element of cash flow involved, and for that reason, you need to immediately recognize in the period in which it was settled, translated, which the rates are different from the rates at which it was originally recognized, or any asset which was pertaining to a previous financial statement. Right. Now, there is an exception, which I touched upon earlier also. So, any different forming part of the reporting net investment in foreign operation. So, the net investment, any monetary asset, which is they are saying it is not repayable immediately. That means it is deferred. That monetary asset forming part of your net investment in foreign operation, any foreign exchange effects, kindly record it in your profit or loss in the separate financial statements. Whereas the same item, when you do a consolidation of the reporting entity and the foreign operations, kindly take it into your OCI and reclassify to P&L. You have to reclassify when an event occurs. What is the event? That event of disposal of the net investment in the foreign operation. That's what it talks about.
Yeah.
Yes, and yeah, just to continue, so it also talks about when you're recognizing something in the for non-monetary item in other comprehensive income, then any gain or loss you're recognizing. For example, in Ind AS 16, a property, plant and equipment, when you revalue, the revaluation goes into the other comprehensive income. So when you do that, any foreign exchange gain or loss associated with that event, where does it go? It again goes into OCI. It doesn't go into the P&L. So that is again a subtle difference with the standard articulates. Well, over to you, Shravan.
Thank you, sir. Maitreyi Madam, the net investment in foreign operations that Venkat sir touched upon, would you like to add any inputs on what could be further factors that one should keep in mind? Do you want to add upon anything?
Thank you, Shravan. So when an entity has net investment in foreign operations, we touched upon earlier first time, determination of functional currency of the foreign operation. That's the first step to be done. Subsequent to that, there will be the translation of all the foreign currency operations items in the P&L as well as the balance sheet into the same currency as the parent entity. And that is done, all assets and liabilities in general, as a general rule, are translated at the closing rate. And when I say assets and liabilities, it includes goodwill. All income and expenditure items are translated on the date of the transaction or based on the average rate that is determined for a certain period. If the number of transactions is large and the fluctuation in rate is not very volatile. And any differences that arise after such translation, these differences are accounted for as OCI in the consolidated financial statements. Now, one very significant challenge that will arise when we are doing a consolidation is, when we are following Ind AS 110, anything that's an intra-group balance will knock off ideally. But since we are following the functional currency concept both for the foreign operations as well as the parent entity, the foreign operations have their own functional currency, the parent entity has its own, and they are translated at closing rate. On account of that, a direct elimination of the intra-group items will give rise to currency fluctuations. So where there is an intra-group monetary asset, and here is where it is important to differentiate between a monetary and a non-monetary asset. So where there is an intra-group monetary asset, whether it's short-term or long-term, then, the results of the exchange fluctuation So the results, whenever you're trying, it cannot be eliminated against the corresponding intercompany liability without showing the results of the exchange fluctuation. So that's where the OCI account will have to come in, because each of them has a different functional currency. In addition to that, what Venkat sir just touched upon, that when there is a disposal of the foreign currency operations, it's only at that time that the balance in the OCI will have to then be reclassified from the OCI account to the P&L account. If there's a disposal of the foreign operation, that's the only time. Now, there are a lot of details about whether the disposal is partial or total. And I'm sure we'll touch upon details of that. That itself is quite a detailed discussion on that. But only when there is a disposal of the foreign operations, the interest in the foreign operations, that's when a proportionate share of the OCI will move to the P&L account. Apart from that, when you are translating foreign operations, there may be a different closing date for the foreign operations than when the parent is closing. Now, if the foreign operations prepare additional financial statements, then it's fine. We prepare additional financial statements and close them on the same date. But if the foreign operations don't prepare separate financial statements, then Ind AS 110 allows for a different date. So as per that, if the difference of the closing dates of the two operations do not differ by a period more than 3 months, then only adjustments can be made for any significant transactions or events that occur between these two dates. Otherwise, we can pick up the financial statements which are within the last 3 months and apply the translation to them. So these are various considerations that need to be taken into account while translating foreign operations. Shravan, over to you.
Sure. Madam, continuing with this same question, what are the specific things that we have to keep in mind in case of recognition of exchange differences arising on translation of long-term monetary items from foreign currency to functional currency? Could you please let us know? Madam, you're on mute.
Sorry, thanks for that. So an entity may have a monetary item that's receivable from or payable to a foreign operation. And when such a long-term monetary item is in terms of a loan, and it is planned to be received from the subsidiary, then it is treated as any other asset or liability. But where a loan to a foreign operation there is no date by which the loan needs to be repaid, where it is almost in terms of an equity infusion, and there is no immediate plan of recovering the amount from the foreign operation, then such a monetary item that is receivable or payable to a foreign operation is treated as part of the entity's net investment in that foreign operation, if the settlement is not likely to occur. And so if the settlement is not likely to occur, then it will be treated as equity, and the exchange differences on that will be taken to OCI. In all other cases, it will be treated as normal monetary assets where the differences will be accounted for. So over back to you, Shravan.
Sure. Venkat sir, let's spend a few minutes on foreign operations. I have two questions actually. So what are the things to be kept in mind with respect to financial statements of foreign operations? And also, as you answer that, could you also cover the aspects relating to disposal of such foreign operations as well for us?
Okay. As far as the net investment in foreign operations and the transactions between the reporting entity and the foreign operations is concerned, there could be monetary transactions, there could be non-monetary transactions, not monetary items, non-monetary items. So there may be circumstances when a monetary item forming part of the net investment in a foreign operation is denominated in a functional currency of the reporting entity. So it's considered if you is in this denominated in the functional currency of the reporting entity, you need to book a foreign exchange gain or loss in the foreign operation. Similarly, it could be denominated in a functional currency of the foreign operation, in which case you need to book a forex gain or loss in your reporting entity. If it is neither in the functional currency of the reporting entity nor in the functional currency of the foreign operations, you need to book foreign exchange gain or losses in both the entities, one the reporting entity as well as in the foreign operations. That's one thing which you should take care. Such exchange that's for the separate financial statements, SFS. In CFS, the consolidated financial statements, these goes into the comprehensive income, other comprehensive income, OCI, and that include foreign operations and the reporting entity together on the consolidated statement of accounts. Now, to your second question on disposal or the partial disposal of foreign operations, the foreign exchange relating to the foreign operations, which is recognized in the other comprehensive income and accumulated in a separate component of equity, shall be reclassified from the equity to profit and loss when the gain or loss is recognized. When the gain or loss on this presentation, AS1, presentation of financial statements, Ind AS 1, when you are recognizing the gain or loss on the financial statement, at the same time, you have to reclassify whatever is there in the OCI to the profit and loss. Now, a derivative of all of this thing is on disposal of a subsidiary that includes foreign operations. What happens if there is a disposal of a subsidiary that includes foreign operations? The cumulative exchange difference attributable to the non-controlling interest shall be de-recognized. The standard is very clear. De-recognized. Don't move it into the profit or loss. De-recognize the share of the non-controlling interest, the foreign exchange difference attributable to the non-controlling interest, de-recognize it if it is case of a disposal of a subsidiary, with that includes a foreign exchange. Now, what happens on a partial disposal of a subsidiary that includes foreign exchange? The standard is very clear. He should reattribute the proportional share of the cumulative exchange differences to the non-controlling interest. So what is the proportional share of the cumulative exchange in the OCI? Reattributed to the non-controlling interest for the reason that it's only a partial disposal of a subsidiary of foreign exchange. The third one is when you have other partial disposal of a foreign exchange, when this is the ancillary clause. The entity says you reclassify to profit and loss account only the proportional share of the cumulative exchange difference in OCI of the reporting entity. Only that you need to reclassify only the proportional share into the profit and loss account. That is one other partial disposal of a foreign exchange. Over to Shravan.
Thank you, sir, for touching upon the specifics on foreign operations. Next question is to Maitreyi, madam. Madam, initially when we were discussing about the first-time challenges when there is a company which is transitioning into Ind AS 21, you specifically mentioned about the very concept of functional currency being new in nature. And you also mentioned that the very fact that a functional currency has to be looked into, it's not really a choice for the entity. Right. So can you talk about where there is a situation where the presentation currency is different from functional currency? So how does Ind AS 21 deal with such kind of a situation?
So Shravan, where the presentation currency is different from the functional currency, the items have to be translated into the presentation currency for being presented in the financial statements. It's a choice of an entity how they want to present their financial statements, and if the users of the financial statement find it more useful that the presentation is made in a different currency, it can be made. For that translation, assets and liabilities are to be translated at the closing rate. All income and expenditure will be translated on the date of the transaction or the average rate for that period. And any differences that arise will move to OCI. That's the broad rule of translation of from functional currency to presentation currency. Over back to you, Shravan.
Thanks for that clarification, madam. Venkat sir, can you broadly touch upon the disclosure requirements when it comes to disclosures in the financial statements as per AS 11 vis-a-vis Ind AS 21?
So, as far as the disclosure is concerned, both the standards provide for the disclosures, the respective disclosures, where one standard talks about the presentation currency, the other one talks about the reporting. AS 11 talks about reporting, Ind AS 21 talks about the presentation currency. So it says when the presentation currency is different from the functional currency, which could be a case like Matriji touched upon, where you need to translate from a functional currency to a presentation currency. The facts that the event is happening with the disclosure of functional currency, what is that functional currency, and the reasons for using such different presentation currency should be very clearly articulated as a disclosure. Whereas in the AS 11, where the reporting currency is different from the domiciled country, the currency in the domicile is nothing but the reporting entity in the Ind AS 21 parlance, should be disclosed. The reason for any change in the reporting currency also to be disclosed. So this is one of the differences. So where any change in functional currency, now, sir, in the standard talks about, which is a very rare case of changing a functional currency. Not many corporates do that. But in case you want to do a change in the functional currency, then it says whether of the reporting entity or a significant financial or a foreign operation, the fact that the reason for change and the date of change shall be very clearly disclosed in Ind AS 20. No such disclosures has been articulated in AS 11. Then also Ind AS 21 also further says that if you say that the reference to compliance with the standard will be made only if they are compliant with the requirements of each applicable standards for of recognition. So that is one thing which AS 11 does not touch upon. Amount of exchange differences recognized in the profit or loss. Amount of exchange differences in 11, AS 11 talks about it should be included in the net profit or profit or loss for the period. So I think that's pretty much one. Then I think the differences on the OCI as well as the foreign currency translation reserve. Right. In India is very clear. There's a very subtle difference. There's a very pertinent difference. India is 21 talks about OCI, and the AS 11 it goes into foreign currency translation reserve. Over to you, Shyam.
Sure, sir. Bringing the next question to you only, are there any differences at all when we talk about IAS 21, when we compare IAS 21 with Ind AS 21? Are there any differences? If yes, can we understand a few of them?
I think the transitional provisions for the Indian accounting standards is given in first time adoption 101. Whereas the transition provisions are available in IAS 21 with the respective India is very pertinent. I think translation, the foreign currency translation on long-term monetary assets can be for a period prior to the end of the period, beginning from prior to the beginning of the financial period, which we have calculated, which have computed based on Ind AS 21. We can that. It's a one-time option. It's a one-time option. You can take that one-time option, go forward, and use that foreign currency translation reserve, which has got foreign currency translation on long-term monetary assets. You can move it over a period of amortize it. That's the word used in standard. Amortize it over a period of the life of the asset or liability. So, but in any fresh one cannot happen in the Ind AS. So that exemption is given in a 101. Which is nothing but a first-time adoption standard. Then on a verbature front, it talks about balance sheet, whereas in IAS 21 it talks about statement of financial position. And the change in functional currency, IAS does not talk about the date of change. Maybe that's not a requirement, whereas it's a very clear requirement in the Ind AS 21. What is shown?
Right. Thank you, sir. Maitreyi Madam, when we talk about forward exchange contracts, can you explain the effect of foreign exchange rates in such contracts?
Yeah, Shravan. Shravan, basically forward exchange contracts are not part of Ind AS 21 and would be treated according to Ind AS 109 as we discussed right at the beginning. But very briefly to talk about forward contracts, where the net fair value of the right and the obligation in the forward contract is not zero, that's when the contract is recognized either as an asset or a liability. And the recognition of the asset and the liability is not on the date when the settlement takes place, rather on the commitment date. So the exchange rates that would apply are based on the exchange rates on the date of the commitment. So that is very briefly. We'll have to get a lot into detail into Ind AS 109 if we are talking about forward exchange contracts. So I'll just keep it very brief and high level at that.
Sure. Yeah.
So over to you, Shravan.
Sure. Continuing the same conversation, Venkat sir, what is the treatment of tax effects of exchange differences? Can you throw some light, please?
Yeah. So the tax effects are there for this foreign exchange differences also. So the non-monetary assets and liabilities of an entity are measured in its functional currency. That's fine. That's agreed. Now, if the entity's taxable profit or loss, that's the tax base on this non-monetary assets and liabilities, is determined in a different currency, then what happens? There will be changes in the exchange rate. So when there is a change in the exchange rate, that will give rise to a temporary difference, which will result in a deferred tax liability or an asset. So that is the subtle point. It is you need to refer to Ind AS 12 on income taxes, where it gives you this guidance on the deferred tax recognition of deferred tax liability or an asset. Now, also an additional point will be when a parent controls the dividend policy of the subsidiary. Now, suppose subsidiary is the foreign operation, and the dividend policy of it is controlled by the parent. The timing of reversal of temporary differences associated with the investment is also indecisive. So you never know when the dividend policy, because it's the discretion of the parent can take the shots as to when the dividend has to be paid by the subsidiary. The temporary differences, which will include not only from undistributed profits, but will also on the foreign exchange translation reserves. So that again is the mercy of the reporting entity. So that there also there's a possibility of a deferred tax liability and asset arising.
Right.
Over to Shravan.
Yeah. Maitri, madam, my next question is to you. The functional currency that is chosen by the company at the time of transitioning into Ind AS, does the standard permit for this functional currency to be changed in the subsequent periods? And if yes, what happens? I mean, how does the company will have to, foresee, or are there any changes or impact that has to be brought into the books when there is a change in the functional currency, please?
Shravan, like we discussed earlier, the functional currency depends on the primary economic environment in which an organization functions. So ordinarily, this fact of the economic environment in which an entity functions is not something that changes very often. But there might be a rare circumstance in which there's a change. I'll share an example. An entity that is primarily operating in the Indian market and selling goods in the Indian market may receive a very large export order, where the primary market in which it sells, because the export order may then later constitute, say, 80% of its revenue, and the India sales may continue to be only 20%.
20%.
So where that dynamic shifts and the primary economic environment in which the entity operates has changed, then a determination of change in functional currency is possible.
Right.
And that again is a management call and has to go as per the fact pattern for determining the functional currency. If the functional currency changes, whenever that happens, the change in functional currency and the translation procedures that are applicable will be applied prospectively from the date of change. So again, what we mean by prospective is the financial statements of an entity may include certain foreign currency items earlier that have been translated and brought into the financial statements. These will not be retranslated to the original currency, but will be translated from the first functional currency to the second. So all changes are prospective and do not need to be made retrospective. So that's the impact of a change in functional currency.
Right.
Shravan.
Thank you, madam. Yeah. Venkat sir, having understood the elaborate list of changes of the requirements when I'm assume transitioning from IGAP standards to Ind AS, can we also understand if there are any exemptions given to small and medium companies when it comes to compliance with, let's talk about both AS 11 compliant company as well as an Ind AS 21 company. Are there any exemptions to these kind of smaller companies?
To my knowledge, AS 11 is applicable for all the small and medium enterprises in its entirety, and voluntary adoption of Ind AS 21. But once what you need to understand is that once you adopt Ind AS 21, then it compulsorily you need to go the entire hog, was to say the full length you need to go with this Ind AS 21. So that is the key message from as far as the SME is concerned.
Right. Thank you, sir. Madam, is AS 11 applicable to non-corporate entities? Can you?
Shravan, yes. See, non-corporate entities have been classified, level 1, 2, 3, 4. And level 1 and 2, AS 11 applies. Level 3 and 4, it applies, yes, but with certain disclosure exemptions. So there are some encouraged disclosures in AS 11, which are not applicable to level 3 and 4, non-company entities. And, just for information, what is level 1, 2, 3, and 4? Level 1 are the listed companies. These are the large companies listed, or banks, financial institutions, insurance companies, having a turnover of over 250 crores, having borrowings of over 50 crores, or holding a subsidiary of any of these, which are, either listed or banks or, high turnover. These are all considered as large entities and fall under level 1. Level 2 is the medium entities, which means turnover limit of between 50 crores to 250 crores, borrowing limit between 10 crores and 50 crores, or a holding or subsidiary of any of these is a medium enterprise. And AS 11 applies in entirety to level 1 and 2. Level 3 is the small enterprises, which means turnover between 10 crores, 50 crores, borrowings between 2 and 10, or holding of any of these. And then level 4 is micro, which are not not either large or medium or small. So for level 3 and 4 entities, the AS 11 applies, but with certain disclosures that are exempt for them.
Right. Thank you. Venkat sir, when the transaction date and the payment date are different, how should a transaction be recorded? Can you maybe with an example or something, if you can explain?
So initial recording of a transaction will be at the spot rate, and subsequently when the functional currency and subsequently it could be translated or subsequent recognitions can happen at the reporting period, or if it is settled, then it gets settled at the rate at which it is settled, and the foreign exchange gain or loss goes for the P&L. Now, there's an advanced consideration given in an Appendix B of Ind AS 21, very clearly articulates if you receive a consideration or pay a consideration in advance. Suppose I purchase materials, and for purchasing materials I place in advance, or I'm selling some goods to a customer, I receive an advance. So when I receive an advance, it becomes my a non-monetary liability, and if I pay money to for an advance against supply of materials, it becomes my non-monetary asset. So now I have these in my balance sheet, but at the time of when actual the expenses are incurred, or suppose I acquire an asset or an expense where I need to debit in the asset, then the standard very clearly says that the payment and receipt have already been done, but now you're recognizing the asset. The asset will be recognized with the respective standards, right? The recognition which talks about the principles, for example, Ind AS 16 on the property, plant, and equipment, that principle will apply, but the exchange rate is the key point. the standard article is very clearly the exchange rate what you use. Though you will use the principles of the standard which you are using for recognition, the rate which you are going to use is the rate at which the original non-monetary asset was recognized in the books of accounts. So you use that foreign exchange to recognize. So if you have a revaluation of instead of a historical cost, you want a revalue, then it goes into OCI and the gain or loss goes into OCI. So that is the subtle difference between the in the accounting standard on the advanced considerations. Go to Shravan.
Right, sir. Madam, Venkat sir has already spoken about the differences between AS 11, Ind AS 21, and also IAS 21. But we missed discussing on yet another standard that has an implication, that is ICDS. In this case, to be more specific, ICDS 6. By throwing in this into the bucket, are there any differences? Could you throw some light, please?
Shravan, thanks. Income disclosure standards of the Income Tax Authority notified by the CBDT. So ICDS number 6 deals with foreign exchange, and for sure, if there is a different standard, there are differences between how it's treated. Number of differences between ICDS and AS 11, ICDS, and Ind AS. So let's talk about them, one by one. First and primary, like with every other difference, we're going to talk about functional currency. We've already spoken about how Ind AS talks of functional currency as the basis. In ICDS 6, there is no concept of functional currency similar to AS 11. Right. So ICDS 6 talks about foreign currency. Foreign currency is the currency other than reporting currency, and then reporting currency is Indian currency. So except for foreign operations, of course, ICDS defines reporting currency as meaning Indian currency. So, the primary currency differences are there. AS 11, of course, again, doesn't talk of functional currency, whereas Ind AS 21 talks of functional currency. Now, also when you're translating, so when it comes to non-monetary foreign currency items, so as far as Ind AS and AS 11 are concerned, any non-monetary items, I'll talk about non-monetary and monetary separately. So non-monetary items are carried at historic cost, and you take the exchange rate on the date of the transaction, or if they're carried at fair value, then you take the exchange rate on the date of determination of fair value and convert it into either the reporting currency in case of Ind AS or the functional currency in case of reporting currency in case of AS 11 or functional currency in case of Ind AS. In case of ICDS, the non-monetary items shall be used, again, converted on the date of transaction, but exchange differences shall not be recognized to income and expenditure. And recognition of the exchange difference will be subject, of course, to the income tax rules. That is Rule 115, which deals with the rate of exchange, and Section 43A, both will be applied. So that's on the non-monetary items. When you come to the monetary items, in case of ICDS, they are converted into reporting currency, applying the closing rate. And it's the same with Indian GAAP, it's the same with Ind AS. But the exception in the Ind AS is there's corporate entities can capitalize the exchange differences on long-term foreign currency monetary items for acquisition of depreciable capital assets. And you can amortize the exchange differences. That is not possible in case of ICDS. And Ind AS, of course, allows you for the first time adoption to follow whatever has been followed in AS 11. So first time adoption, you can again capitalize the exchange differences, which is not allowed in ICDS. So these are the primary differences for monetary and non-monetary item. Again, when it comes to investment and foreign operation. So in case of ICDS, these are not dealt with. They are dealt with as they are, translate and sort of recognize them for your income tax purposes. But Ind AS and the AS 11 contain very specific clauses for how you translate monetary items that in substance form part of net investment of the foreign operation. So how they will be taken to OCI in case of Ind AS, all that is very specific in Ind AS and as well as AS11, but ICDS does not contain any guidance on this. So those are the differences between ICDS as well as Ind AS and AS11.
Sure. Thanks for that explanation, madam. Venkat sir, these days the companies are increasingly looking at loans which are denominated in foreign currency. So how should the foreign exchange differences on such loans be, disclosed when we are talking about AS11, then Ind AS 21, and also Section 43A of the Income Tax Act? How should these foreign exchange differences be looked at?
Yeah, so a loan as in a loan denominated in foreign currency, the is in AS 21 and AS 11. AS 11 very clearly gives you an option for if they are considered as long-term monetary assets. It gives you an option either to recognize everything in the profit and loss account, or what it also essentially says that you can opt for taking that foreign exchange differences. So it talks about categorizes into two different areas: for acquisition of capital assets and for other than acquisition of capital assets. So in this case, loan will come under other than acquisition of capital assets. So in this scenario, any foreign exchange gain or loss, take it to a foreign currency translation reserve account, amortize it over a period of the life of the asset or liability. So you can do that. Your option once you take is forever, and AS 11 very clearly gives you a definition of a long-term monetary asset, which is more than 12 months. There is no such guidance is there in Ind AS 21. Ind AS 21 where it talks about non-monetary items are recognized at the historical cost, and using the exchange rate at which the data on the date of the transaction. If it's done at fair value, then you do on the day when the fair value was recognized, use that date as your recognition criteria, subsequent recognition criteria. As far as 43A of the income tax, it's a non-substantial clause. It says it begins with saying notwithstanding anything contained in any of the provisions of the Act. That means it overrules every other provision of the Act. So it has to be really looked at from that angle, as Section 43A of Income Tax Act very clearly articulates that if any acquisition has happened in a foreign currency of a capital asset, and subsequently at the time of payment, you have a difference between the payment currency and the currency in which it was acquired, you get a foreign exchange gain or loss. So what do you need to do with that foreign exchange gain? It very clearly says that those have to be added to the cost of the asset. That is where 43A, it overrules every other section, and it says that any loan, when the capital asset, when I'm saying that you have if you're taking a loan also to acquire a capital asset, any fluctuation at the time of making the payment, when your liability is getting increased or decreased due to the exchange difference at the time of making the payment, vis-a-vis the time at which the acquisition of the asset had happened, or at the time the loan was taken, use that plus or minus the differentials adjust into the capital asset. So this is the subtle difference between all the three as far as the loan denominated in foreign currencies. And yeah.
Right. Madam, picking up from where Venkat sir concluded, how will the foreign exchange difference on interest on loan in foreign currency be treated? Can you throw some light from the point of view of AS 11 as well as Ind AS and also ICDS 6?
Shravan, the interest on loan in foreign currency is a monetary item, and ICDS says that exchange difference on monetary items will be converted in the last day of the year and recognized as income or expenditure. It's the same with Ind AS or AS11, that exchange differences are taken to statement of income in the period in which they arise. Now, in case of Ind AS, again, it's subject, of course, to Section 43A, which is Forex on capital assets, or Rule 115. Now, in case of Ind AS, the If the exchange difference is on account of a loan to a foreign operation, which is to be treated as part of net investment, then the exchange difference will be taken to the P&L account in case of the separate financial statements, but in case of the consolidated financial statements, it will be taken to the OCI. In case of AS11, of course, it'll all be accumulated to the foreign currency translation reserve until the disposal, and then only it will be moved to P&L. So between ICDS and Ind AS, the only difference is in how you treat the loan to a foreign operation, where it is treated as part of net investment. That the interest on that is where the difference arises. Otherwise, it's all converted as a monetary item in all three.
Right. Sir, Venkat sir, the next question is to you. Since you already touched upon the exchange difference on loans that are denominated in foreign currency, what about the treatment of exchange difference for capital asset as per IGAP standard, that is 11, and Ind AS, and also specifically 43A of the Income Tax Act, please?
Yeah, so 43 is common for acquiring a capital asset or for taking up a loan for the acquisition of a capital asset. And the same 43A non-substantial clause will apply, and which very clearly articulates that any such differences arising between the date on which the asset was purchased and subsequently when the payment was due, any foreign exchange differences due to the difference in between the currency exchange between at the time of recognition or the time of payment will go on to add to the capital asset under section 43 and or to an expenditure of a capital nature under section 35 and so on. As far as AS11 is concerned, the option of like I said, there's an option to take where instead of taking into the P&L account, you have an option where you are acquiring an asset, capital asset, any foreign exchange gain or loss arising due to the acquisition of the capital asset can be deferred by way of adding to the cost of the asset and can be depreciated over the life of the asset. That is the option given in AS11. Whereas in AS 21 does not talk about any of such exceptions. So if any non-monetary asset is non-monetary item is acquired at its total cost, it goes under at the rate of exchange on date of transaction on which it was recognized. And if it is done, whereas if it's a capital asset which has got a revaluation under the Ind AS 16 property, plant and equipment, then the date on which it was fair valued will be the date on which the transaction will be accounted for. So there is no question of any adjustments happening on foreign exchange differences between the time at which it was recognized and the time at which payments are happening, because once the payment happening, it becomes the payable goes into a monetary asset, and capital asset being a non-monetary asset. So that's the key. You need to have a clear demarcation, because if I may touch upon an additional point of non-monetary asset, whether it is non-detenable, it's not being repaid over the near future, then it tantamounts to, when you talk about net investment in foreign operation, it goes into a mode where you are saying there is no immediate cash flow coming into you, and it takes the color of a long-term, though it's monetary in nature, but because of which there is an option given for it to be taken into the OCI and not into the P&L in the consolidation set of financials. So I think, yeah, that's it.
Sure. Venkat sir and Maitreyi madam, let us take a few questions from the audience. I'll just read the question. Maybe whoever is comfortable can pick the question, and I mean both the panelists can add your views. The first question is, in case of a company having operations in many geographies, it has to deal with multiple currencies. For comparison purpose, it calculates constant currency rate. So there are a few questions in relation to this. How do you calculate the constant currency rate? This is the first question. Anybody?
There's an option, and Venkatji, please feel free to add to what I'm saying. But as for accounting purposes, there is no option of a constant currency rate that is available. For management information system purposes, for your MIS reports and other things, you might have the option of taking a constant currency rate if there is not much volatility in the currency. But for accounting purposes, the option of a constant currency rate is not envisaged in Ind AS. Venkatji, I don't know.
Yeah, thank you, Maitriji. I think I echo your views. The standard does not give any constant rate of currency. The standard very clearly talks about only functional currency. Therefore, any currency other than a functional currency is a foreign currency. So the questionnaire, with due respect, could be a foreign currency for all practical purposes, cannot be a constant currency. If you want to move it into a functional currency, then you have to follow the guidance issued by the standard and translate from your foreign currency. It could be a transactions on a foreign currency or your foreign operations per se, which will have its own functional currency, which could be a different functional currency from the currency of the reporting entity. Then you need to go ahead and translate it. And there is an additional concept called a presentation currency, which this standard talks about, where you can present. And there could also be a possibility that you maintain your books of accounts different from a functional currency. So the standard also provides a view that if you are maintaining books of accounts in a currency other than a functional currency, you convert everything into a functional currency as if the functional currency was rolling right from day one. So does that answer your question?
Sure. I think the member also has a few follow-on questions, but your inputs kind of already answered that second question also. Member was asking if there is a possibility of companies overstating or understating the constant currency rate and thus skew the comparison, etc. But I think that kind of is answered with your inputs for the first question itself. So moving on, there is another question. For the purpose of reporting foreign currency transactions in the functional currency or translating financial statements from functional currency to presentation currency, exchange rates from which source has to be used? If exchange rates from multiple sources are available, which is the most authenticate or the go-to source?
I'll try and take that. So there might be a situation where multiple exchange rates are available,
Right.
There might be an RBI rate, there might be a bank rate, and so on. So the company should really use that rate which is most likely used by it in transactions. So say the exchange rate provided by my banker. If I'm the organization, I'm banking with a certain bank, then the exchange rate provided by the bank would perhaps be the most appropriate. Or the spot exchange rate for the foreign currency on that date of transaction, which is applied to the transaction, may be the most likely currency that you should use. So just the availability of multiple rates does not mean that I have a choice of the rate. The rate that is applied to transactions generally, that as an organization that I enter into, should be the rate that I use. And at some times, when the entity is entering into buying and selling transactions, then you might adopt a separate rate for buying transactions and a separate rate for selling transactions, which are both published by authenticated sources on a regular basis. Like, for instance, in my experience, I work with an organization that used to use the State Bank of India TT buying rate or the TT selling rate to consistently translate all transactions. So consistently adopting a rate declared by a well-known bank with a large number of transactions, if we don't have a large number of transactions, or by our own banker, if that is the bank that is dealing with our large number of transactions, is most appropriate. I'll pause here for Venkatji to add his thoughts.
No, I think I go with your thoughts as well, Venkatji. I think I totally echo it. Preferred bank rates so that the auditors don't question you. You use the bank rates which you follow that in particular industry rather than trying to choose from various alternatives which are available. And so ultimately, end of the day, you need to satisfy your auditors as well.
Right. So to sum up, it is the most likely used rate by the company and consistency is the key. Right. So the next question is, when an entity has subsidiaries and associates that are located in various countries, how is the functional currency determined for the purpose of preparing CFS, Consolidated Financial Statements?
So the functional currency determination is very clear. We talked about it should primarily drive the sales price of goods and services. It should also talk about in the environment where the regulations and your competitive forces determine your sales price. And one more indicator, the second indicator, which talks about the costs, the material, labor, and other costs, which are for providing those goods or services, for providing those services. So, what is the currency in which it is being used? And additional indicators where you're funding your requirement. Suppose the main currency in which you have got your funding done would determine your decision on the concept of functional currency. It could also depend on your receipts, your operating receipts, because the next barometer is the operating. Once you do a financial funding, then how much of the funds you're using in your operation, how much of the funds you're able to garner from your operations, and how much of you are retaining it will again determine your functional currency. And additional indicators also are there. There are 3 indicators where the operations, your operations as for your foreign operations happen to be the majority of your total operations on the whole of the reporting entity. Then it will drive whether they are able to repay their loans. They got the loans, repay the loans from the amount they are able to generate cash from their own operations. That also will be a determinant. Or are they sending all the funds to India? Or is just a significant, is the foreign operation significant in terms of the reporting entities' overall operations? Which also would explain that these all things put together will determine. And very clearly, the one guidance which we need to follow is that if your primary indicators are pointing to a particular direction, you better go to that direction. Don't even explore any secondary indicators, because there's no point in exploring. Only if your primary indicator is not very 50-50 chance, go and explore your secondary indicator, so that will substantiate your decision making on your finding out which is your functional currency, because that is a very important determinant for applying the standard. Does it answer the question?
I'll just add to what Venkatji said. I think the person who's asked the question is also, specifically emphasizing on the number of associates and subsidiaries that are located in multiple currencies. Right, I think the determination has to be made for each entity in isolation. The functional currency has to be determined for each of these entities. And when we are talking about consolidated financial statements, then the functional currency has to be determined for the parent entity into which the subsidiaries or the associates will be consolidated. And the functional currency determination of the parent has to be made in isolation of the subsidiaries. And that determination will continue for the consolidation. So I just wanted to add that, because I think the person who's asked it is emphasizing on subsidiaries and associates.
Great. Yes. The next question is more from the point of view of monetary item determination. The question is, when an entity has received advance consideration from a foreign customer or has paid advance to a foreign vendor, whether the said advance consideration is to be regarded as a monetary item.
It's a non-monetary item, because if your advance is against supply of materials, very clearly you're not going to get the money in return. So there's no cash flow coming back. It's only going to come in the nature of goods or services. Similarly, when you receive an advance against a shipment of goods or shipment or provision of services, until you're not going to return, it will be lying in your liability. But when the liability gets reversed, it gets reversed into your revenue. So and there is no fixed. So monetary asset is what? Anything coming back in fixed and determinable cash inflow. So that would determine your monetary asset. So these are non-monetary in nature. Even if at the end of there is a penal clause, till the time the penal clause is affected, the penal clause is that I don't ship the materials at the end of the period. I don't ship the materials, and I have to pay back the money. I mean, I don't ship the materials. Whatever I received from the customer, I have to pay it back. So even that, till the time you determine it reaches that end point, it is still a non-monetary asset and liability for all practical purposes. Maitriji, do you agree, or you have any counterpoints?
I'll agree with you, Venkatji, only that I feel the contractual terms and the facts at that point in time need to be taken into account. Like you said, at the point, if it's a refundable advance subject to certain conditions, if those conditions have been met, then the determination of its being a monetary asset will be there. Otherwise, in ordinary circumstances, it is non-monetary. But again, that determination from period to period will need to be made depending on the conditions in the contract.
Thank you. Thank you, both of you, for clarifying that. The next question by the member is, apparently the member has seen one accounting policy which states that the monetary items denominated in foreign currency are stated at contracted rates as those are covered by forward contracts. So the member's question is this in line with AS 11? Any of you would like to take that?
While forward contracts are covered by AS 11, I'm a little fuzzy on how AS 11 deals with forward contracts. Venkatji, if you...
Yeah, I think AS 11 talks about unless it is determined the effectiveness of the hedges, and if the amount is determinable, the hedge, if there's a cash element which is clearly determinable, then what the member is saying is right. It can be considered, because that is the only part which is covered by AS 11, not the entire gamut of forward contracts. You have to look for a guidance elsewhere. I think that is my view. Maybe
right.
Yeah.
Sure. Moving on to the next question. If the entity also presents supplementary financial information in a currency that is different from both its functional currency as well as presentation currency, what are the required disclosures for this supplementary information? It's more of a question on the disclosure front.
The question is on supplementary information.
Supplementary financial information. If the entity is also presenting this additional information in a currency that is different from the functional currency as well as the presentation currency, then what are the additional disclosures for such supplementary information is the question. If there are any specifically, that is.
So I'm a bit boxed by this question. Supplementary, because you either have a functional currency or a presentation currency. Because you are giving to shareholders, you do it in a presentation currency. If it is different from functional, otherwise, a functional currency itself will be a presentation currency. The third, what is the end user? Who's the end user of the supplement financials? I'm not sure.
So, an example of this, Venkatji, might be if you say got a bank guarantee in a third currency, which is neither the presentation nor the functional currency, and there is some issue with the bank guarantee which requires specific disclosure in the notes to accounts, which is a possibility that may arise. There may be a third currency that may require some kind of disclosure, a transaction. But even if we disclose such transactions, it is essential to make the disclosure in the presentation currency as well. Just a disclosure in a third currency will not suffice. At least that disclosure in the presentation currency is absolutely essential to make the reader of the financial statement be able to associate the numbers with the numbers in the financial statement that they are reading.
Right. The next question from one of the member is, if any of the speakers can touch upon the translation of a foreign subsidiary with a different reporting date from that of the parent company, which rate has to be considered for consolidation purpose?
So where a subsidiary has a different reporting date, but the reporting date is within 3 months and they're not preparing separate financial statements, the same financial statements and the exchange rate on the date of the parent's financial statement will be used.
So if I may add on, the reporting, if it is able to, you give a reporting, a list of financials, if it's able to give on the reporting date as the reporting date of the reporting entity, it's good. You can easily consolidate. But if it's not able to give it, and if, like Maitriji rightly said, 3 months is a gap, it can do it on a date where it closes the books. But any significant events or conditions will have to be accounted for. That's what the standard says.
Right. Venkat sir and Maitreyi madam, we don't have any further questions from the audience. Would you like to share any concluding remarks, anything specifically that you think would add value further to the audience, or else we can conclude the session?
Thank you so much for your time. I would say for comparing Pramodji, Maitriji, and all the members supported us, Shalini, Kulashekharji. Thanks to everyone for inviting me.
Thank you, Shravan, and thank you, Venkatji. It was a pleasure, participating, and the questions were spot on. So thanks for having us on the session, and thanks, Shravan and Venkatji and Pramodji.
Thank you. Thank you to both the speakers. Pramod sir, you can pitch in for the concluding remarks.
While we're
Pramod sir? Okay.
While we're waiting for Pramodji, perhaps
go ahead, madam.
Venkatji, just discussion between us on a topic on the exposure draft. We are getting an exposure draft under Ind AS 21 on currencies where the exchange rate is not available. There's lack of that information on the exchange rate.
Okay.
So any views on that? We are all looking forward to it, of course, but I have no practical experience of a currency. I'm sure there must be. For instance, with say Ukraine, when there was a war-like situation and regular exchanges with their local currency were not possible. Right. But if you have any practical insights into that, it might make for an interesting discussion while we wait for Pramodji to come in.
Currency not being made available, and then trying to figure out what sort of currency should be used as a functional currency. Is that the question? So we have been working in industries where stable economies, multinationals, so either they ask you to do in euros or in US. Wherever I work for US multinational is dollar, and where I work for this European multinationals, whether it's Germany or English, pound, GBP or euro. So it needs a lot of thinking to understand. So is it already on the exposure draft, or is it?
There is an exposure draft on it, and there's also an international accounting standard limited sort of review that has been done and published on how to deal with such currencies. And I think it's come in the wake of such international events only. But I have not had practical exposure of working with such organizations. And I was wondering if you have any. It will be interesting to understand,
Sure.
Practical application of this.
Absolutely.
But it's like you haven't had that either.
No.
The other one is, which I haven't had exposure, again, hyperinflationary and how that might impact exchange differences. And again, I've been thinking of where such practical experiences might have been, but unfortunately, I have none in that front. We've got Pramodji here now.
Yeah, we're just waiting for Pramod, sir.
Yeah. Thank you, Shravanji. In fact, it was a very enlightening session. discussed various points relating to the foreign exchange transactions and the translations, to be very frank. And we have also discussed the AS, the Ind AS, the ICDS, the Income Tax Act. So covering from all the point of view, very, very important component of our financial statements as of day to day. And with the India growing and soon to be number 3, number 2, and then number 1, the international, the transactions international would be exceeding far to our expectations, both the inbound and the outbound. So in fact, today we have not discussed about the FEMA implications of the inbound and outbound, but yes, the foreign currency transactions impact and the translations for the purposes of the financial statement as per our accounting standard and the impact. And thank you very much, Venkatji, Maitreji, for sparing your time and sharing your views on the various issues which have been asked by Shravanji. Again, thank you for joining at such a short notice, but that shows that the deep knowledge which you have of the subject, you were able to contribute that through asking the questions and understanding the nuances of this accounting standards and the Ind AS. And I thank the support team, Shalini ji and Kushekara ji from the ASB, and I thank all the participants for keeping hooked in this time also. Thank you, everyone. Thank you very much.
Thank you. Thank you so much.
Thank you. Thank you.
Thank you.